Welcome to our 10th annual Latitude Wealth Investment Forum. We are very privileged to have 3 wonderful guest speakers today that's going to share key insights and pearls of wisdom. Please don't leave your seats because 3 clients can each win a R500 voucher by simply answering the following question. How many more times did global banks inject stimulus into economies post-COVID when compared to the GFC? Simply send us an email with your answer to be part of the lucky draw.
We are pleased to have our very first lady guest speaker, Kathy Lammis, with us today. She is the Business Development Manager at Glacier by Sanlam. Kathy is not only passionate about her work, but also about life in general. She will leave you inspired and motivated to grab opportunities.
Kevin Links, Stanlip Chief Economist, needs no introduction as he has been in the investment industry for more than 30 years. He has an exceptional talent by building watches and has an impeccable relationship with time and arrived bright and early for today's forum.
Ian Power, Chief Investment Officer of Truffle Asset Management, has been part of the Truffle team for longer than a decade. Ian is extremely active and enjoys a healthy lifestyle. He is also a very good rock climber and recently won a regional competition. Sit back and enjoy the next hour and a bit with us.
It's so wonderful to be part of an industry that acknowledges the changing role of women, the way we make our money, the way we spend our money, and the way we invest our money. It's both an exciting and a confusing time. Exciting because we've come so far, but confusing because when it comes to finances, there still is a great gender gap. Women are the first to admit our circumstances differ, and we are the first to put our hands up and say we would actually appreciate advice. Yes, we understand that instruments are gender neutral. A bond is a bond, a money market is a money market. But we approach these instruments with different attitudes because of our circumstances. There are more women now who are single by choice than any other period in history since the Second World War. So it behooves us to look at these special needs and how it accommodates our investment choices. So let's look at the facts. The good, there is some good. First of all, the fact that it's so exciting, and that women make up the largest emerging market in the world. It's also predicted that in some first world countries, by 2028, women will actually overtake the earnings potential of men. Currently, a third of businesses around the world are already owned by women. And also by 2028, it's predicted that women will own up to 75% of the discretionary spending power in the world. The not so good, only about a third of us own our homes. Very few women have an emergency fund. Some women have a secret bank account. They feel the need for that. Very few women have a little nest egg saved away for a rainy day. And unfortunately, some women still regarded as too aggressive and unfeminine to be involved in, for example, the stock market. Now for the really, really, really ugly. According to a study done by Alexander Forbes, women specifically are woefully under-prepared for their investment years in retirement. And there are several reasons for this. First of all, the pay gap is alive and kicking in South Africa, and there could be a difference of up to 40% in the pay of men and women. Secondly, women take out a few years in their career, sometimes up to 10, to take a step back and raise a family. This inevitably affects the money that goes into the pot for their pension fund. So it's almost as though they are on a back foot to start off with. Further to women being woefully underprepared for their retirement years, women are also often the primary caregivers. Would you believe that 2/3 of births registered in South Africa have no father on the birth certificate, which by default means there are a whole lot of single mums out there raising children, which of course is a huge impediment in their ability to save for their future. Women specifically, when investing, are much more aware of their feelings and how they feel about money. Think of your first experience of money at home. Perhaps it was an emotional one. Perhaps money was the source of fights. Let's go even further back to fairy tales. I can't think of a single fairy tale where the damsel in distress wasn't rescued. Cinderella, Sleeping Beauty, Snow White and the Seven Dwarfs. It's almost as though we've been wired to think that someone else is going to take care of us. But we need to take care of ourselves. We also have to face reality that this is a journey. But the great news is, it's not a journey that we need to do alone. And believe it or not, the fun part of the journey is putting together a financial plan, because you can partner up with an expert. An expert will take into account your specific needs and considerations. An expert will ensure that you have all of the basics in place: retirement savings, emergency plan, education. The financial industry is so innovative. The financial industry has really kept with the times, and there are a range of different products at different entry levels to accommodate and personalize a portfolio for almost any client. So, in conclusion, this is a journey. Saving for our future is a journey. You don't have to do it alone. And the best thing we can do is partner up with a professional as soon as possible. I thank you and I wish you well on your financial journey.
Hi everyone. There's obviously a huge amount going on internationally and locally. So over the next 15 minutes, we're going to touch on what's happening in the United States. We'll chat about China a little bit, and then we'll focus on South Africa. For the US, from our perspective, the recovery is strong, right? Their economy has gone to the biggest ever. They fully recovered from COVID. In other words, the stimulus that the US government introduced has worked. Actually, it's worked overwhelmingly good. So from an interest rate point of view, they still have fairly low interest rates, sitting between 0% and 0.25%. It looks to us that they're going to keep those interest rates for a while longer. I'll chat about that a bit later, because that's obviously critical to the investment outlook. But for the moment, interest rates incredibly low. The US government introduced a huge amount of fiscal stimulus, particularly unemployment payments. And by introducing those unemployment payments, they were able to re-stimulate the economy after the initial COVID lockdown. So at some point, the US was paying more or less 34 million people some form of social benefit. And the extent of that benefit, unprecedented in the history of the United States. As a consequence, consumers were earning more by being unemployed than by necessarily having the job they would have had before COVID impacted. As a result of that, retail sales in the US have boomed. Retail sales right now are the highest they've ever been. Employment is recovering. It's almost back to the level it was before COVID impacted. You're seeing a pickup in investment, and generally you're seeing a pickup broadly in the US economy. And so the conclusion is that the stimulus was incredibly effective. The difficulty right now for the US economy is obviously they can't keep that stimulus in place forever. And so they've got to find a way to unwind that stimulus, but do it in a manner that doesn't result in the US economy slowing very substantially. So they've already announced what's called QE tapering. In other words, they're systematically going to reduce some of the liquidity they've been injecting into the US economy. At the same time, they're obviously scaling back the unemployment benefits. Already the number of people that qualify for those benefits have dropped dramatically. At a peak, as I said, it was 34 million. Today it sits at only just over 2 million. So they're scaling back the unemployment payments, and at some point they'll start to raise interest rates. And while that's all going on, they obviously hope that the economy will keep growing at a decent pace. I think that's entirely feasible. I'm not concerned that the US economy is suddenly going to go into a recession. But clearly we're entering a more difficult phase in terms of the US economic recovery. And so that could unsettle financial markets during the course of next year. But for the moment, the data looks compellingly good. The equity markets have responded exceptionally well. They're at all-time record highs. And it certainly feels as if the US has managed the crisis fairly well. If we turn our attention to China, the situation is quite a bit different. China obviously didn't have quite the extent of COVID that other countries had. Obviously, they were the start of COVID, but they brought it under control fairly quickly. And then obviously they've been rolling out their vaccine subsequent to that. And they've done a fairly good job in distributing their own vaccine. Of course, their own vaccine is the least effective of all the vaccines out there, but nevertheless, they've distributed that vaccine to something like 70% of the population, and I think on the whole, that's probably helped. The difficulty China has now is that their economy is maturing, and the way in which you transition from a high-growth emerging market into a bigger, more developed, more mature economy means that you just can't grow the country the way you have in the past. In other words, China's growth is slowing down, and it's slowing down because it has to. You just can't do things the same way that you did previously. Now, there are a couple of reasons why that's occurring. The first is obviously demographics. China doesn't have favorable demographics. They've got an aging population. Their one-child policy has hurt them at this stage. They tend to lack younger people, and that naturally tends to slow down your economy. The second dynamic is there are a lot of companies in China that have become incredibly indebted during this high growth phase, particularly property developers. China was able to grow very fast, partly because it was developing their property sector at a phenomenal pace. But now you get a company like Evergrande, which is the most indebted property developer in China with debt of over $300 billion, and they essentially are bankrupt. They just can't afford that level of debt. And so as a result, they are at the point of potentially going out of business. Now, Evergrande is a huge business, right? It employed at some stage over 200,000 people. It had at one point more than 800 construction projects on the go. And as a result of that, of their indebtedness, Evergrande is now having to scale back. And obviously, apart from Evergrande, it's unsettled the property sector within China. And because property has been so critical to their longer term development, it's undermining some of the growth dynamic within China. Our suspicion is, yes, while Evergrande is a property company, there are probably other companies in China that also have a significant amount of debt and therefore may come under similar pressure in the future. And obviously you've got to clean that up. Just like South Africa, they have highly indebted state-owned enterprises. Those institutions also ultimately have to be cleaned up. And this is really, think of this as a byproduct of growing your economy so fast for so long. It doesn't mean that you're in a healthy shape in terms of the overall level of debt. The third difficulty China has is they've gone back to something called common prosperity. Now, that's something within the culture of the Communist Party, and it's something that the Communist Party has been trying to reinforce within China. So what is common prosperity? Common prosperity, in essence, says equality. China doesn't want to see their system, their economy, becoming unequal, where you have a small number of people that are incredibly rich and everybody else remains fairly poor. So China has seen that rise of income inequality, wealth inequality, and they want to try and reverse that. And so they've introduced a whole range of measures under this umbrella called common prosperity. And by introducing these measures, they essentially are dampening down key parts of their economy where they feel there's been excesses. Things like gambling, they've cut that out substantially. Luxury shopping is being curtailed. Some of the internet activity where they feel people have become exorbitantly rich, they've also curtailed that. All of this in an effort to try and reintroduce the concept of equality. But clearly once you do that, you tend to then dampen down overall economic activity. So you add up those sorts of headwinds that China is facing, and you realize that China isn't going to grow quite as fast as it has in the past. And so as a consequence, you've seen economic numbers out of China be a little bit disappointing, growth rates being revised systematically lower. How much of a slowdown are we talking about? We're still saying somewhere in the order of 5.5% growth, which is incredibly good, right? But it's not the 8, 9s and 10s that we got used to with China. So I think we've got to recognize that the second biggest economy in the world, China, is maturing. They are reorganizing themselves. They're trying to go for quality growth, not just outright growth. They are now becoming more concerned about climate issues, about trying to reduce carbon emissions. All of those are resulting in a restructuring of how they conduct economic activity and overall some moderation in their rate of growth. And perhaps over the longer term, that's not a bad thing. If we turn our attention to South Africa, our problems are fairly obvious. You can start with unemployment. The unemployment rate in South Africa is incredibly high, over 34%. If you break down that unemployment into younger people, that's really where the difficulty lies. And what I think we don't ask ourselves enough in this country is, why do we have such a high level of unemployment? What's stopping us from creating jobs? And in the heart of it, in order to create jobs, you've got to have investment. And by investment, I don't mean putting your money in the equity market. I mean fixed investment, building a factory, building a road, building a harbor. Once you invest in your country, then you have the prospect of creating jobs. And if you don't invest, then you're simply not going to grow your economy and you're not going to create employment. That's exactly what South Africa has been doing for the last 15 years. And right now, our level of investment in this country is the lowest it's ever been. We're not even investing enough to maintain the machinery and equipment that we've had in place. And so under those circumstances, it's no surprise that the unemployment rate continues to rise. In fact, to stop the unemployment rate rising, we would have to add in the order of 600,000 jobs a year. 600,000. We're nowhere near that. At the moment, we're still losing jobs. We haven't even recovered from the impact of COVID on the labor market. So that's the challenge. The challenge is, how do you lift fixed investment? How do you get people investing in South Africa? Now, we know from a lot of research, not just in South Africa, but globally, that the level of investment links directly to the level of confidence. So you can say quite simply that if business is more confident, they invest. So why are businesses not investing at the moment in South Africa? They don't have the necessary level of confidence. And you can see why, right? You can see the corruption, you can see the load shedding, you can see the strike activity, the looting. All of that feeds into a lack of business confidence. And so if you are government and you are earnest, you really want to move this economy forward, what you should be focusing on is improving business confidence. Now, that sounds very negative, mainly because it is. So are there any dynamics that are unfolding in South Africa that make us a little bit more encouraged? There are actually. Let's start with a couple of the near-term things and we'll look broader. geez, our trade balance is remarkably strong. We've got strong commodity prices, we've got brilliant export performance right now, and we are recording record trade surpluses. And those trade surpluses are coming through because we're exporting a lot more. Now, that holds significant benefits. One of those benefits is it's helped the rand, otherwise the rand would have been weaker. And the second huge benefit is that it's helped government tax revenue. And when we look at what government's reporting on tax revenue, way in excess of budget, more than 100 billion rand in excess of budget, which tells you that the pressure on government has eased. Now, that doesn't mean that government should go out and spend or incur more debt, not at all. We hope government does exactly the opposite. But at least that immediate pressure on the fiscal authorities, that's been eased. We have much less prospect of a further credit rating downgrade. In fact, right now, the discussions are about when do we start to see a credit rating upgrade, given the improvement in our fiscal position. And I think that that's been missed in all of this. The improvement in our trade balance and the improvement in our tax revenue has been exceptional in this country. The third key positive is obviously the change in policy direction from within central government. Now, I think you've got to say that that change in policy direction has come about because government's got little choice, right? When you run out of electricity, when you've got massive unemployment, when you've got a lack of confidence, when you've got looting, you have to do something. And fortunately, the government has responded in the right way. So the types of policy government now is looking to introduce is private-public partnerships. Think about government opening up the energy sector to allow the private sector to invest. Obviously, we still got load shedding, but at least we've created the environment in which the private sector can start to ease that pressure in a very substantial way. We've also opened up the port system. So the ports are going to be moved out of Transnet as a separate authority, and government is actively encouraging private sector investment into our ports, starting with Pier 2 Harbour in Durban, which is the biggest container port in South Africa and certainly in Africa. And what we're trying to do is get private sector to invest in the upgrading and the development of Pier 2 Harbour in Durban. If that works, we're going to roll it out to other harbours in South Africa. Realistically, would government have considered that a year ago, 2 years ago? Not at all. That signals a very important policy change. There's no doubt that in the President's office, they've got a department around infrastructure. Dr. Ramaphosa is heading that up. I think he's highly effective. And I think there are many infrastructure projects that government is looking to move ahead during the course of next year. And I'm more and more encouraged that we're going to see evidence of those infrastructure projects. We're making much more progress in the deregulation of business, the so-called ease of doing business. Now, clearly, the more we are able to implement those policy changes, the more we'll start to move this economy forward. And while we wait for those policy implementation, it's going to feel like this economy is treading water, that we're going nowhere fast, because clearly the economic activity is under still huge pressure. We've got high unemployment, low income at a household level. We're not able to stimulate the economy dramatically. Interest rates in South Africa potentially have to go up. We've got a bit of an inflation concern. So in the short term, yeah, there are some headwinds facing South Africa. But I think what people could focus on is that the policy direction from government has changed materially, and there's a determination within the office of the President to try and move this implementation forward. In terms of the Minister of Finance, I also think that he's focused on implementation in a very substantial way. The meetings I've had with him, it's been all a discussion about how do we implement policy. He recognizes that it's not the absence of policy that's a problem. We've got more than enough policy and policy papers. It's about implementing these policy ideas and making them effective. And I think that if we do that, you'll start to see a response from business and the household sector in terms of confidence, and hopefully that build-up in confidence starts to move this economy forward. So that's a snapshot of some of the key things we focused on. I think globally the environment is very encouraging. Financial markets have done exceptionally well, I think. Our markets, not too bad a performance. Obviously, the South African economy still lags. It still feels a bit unexciting. There are many obstacles. But I'm encouraged by some of the key policy initiatives that government is looking to introduce into 2022. Thanks a lot.
Hi everyone, and thanks to Henry and Johan for inviting us to join your seminar. Truffle today really going to give you our sense of looking forward into 2022 and try and give you a sense of adding the I guess investment perspective from a return point of view to what you've already heard from Kevin this morning in terms of the broad economic overview. But before we get into that, perhaps just to give you one or two sentences on Truffle. Truffle, as many of you may know, is a medium-sized boutique business which we've got 35 billion of assets under management, a very experienced team, very disciplined and rigorous process. We focus on downside risks as well as upside, and of course have the nimbleness of a small manager which helps us achieve the top decile returns that we've managed to achieve for our clients since inception. Our balanced fund has achieved real returns of almost 9% real since inception, and obviously this is really what our clients and yourselves need in terms of meeting your long-term liabilities. So just moving into markets, as you would have heard from Kevin earlier, the global economy has recovered from COVID, and certainly markets have echoed what we've seen from a global economic perspective. So stock markets really have done well, and we've seen risk asset prices recover to levels which are, in fact, in many markets meeting and hitting record highs. Now, what are the reasons for this? Because many of us, in terms of our daily lives, we still sort of stuck with COVID and I guess our masks and the way we're sort of operating in this different world. But companies and investment markets have made up all those losses from the COVID-induced panic. And the question is why? And the why really comes because of the medicine that central banks dished out to markets and to the economy when the pandemic hit. And just an interesting observation that I would share with you is that the COVID pandemic, in terms of the impact to global GDP, probably is going to be estimated at about 1/4 of the global financial crisis. Yet central banks around the world brought 4 times the global financial crisis stimulus to fight the COVID pandemic. So in fact, the damage to the global economy was 1/4 of the GFC, yet they injected 4 times the medicine and fiscal stimulus to economies and really creating a very powerful recovery. And we've seen that coming through in terms of the speed at which economies have recovered, but importantly, the speed at which companies have been able to re-establish themselves and continue generating profit and profit growth, and you've seen that recognized in stock markets. Now, one of the consequences of the assistance that central banks, in terms of their support for markets, has been the increased debt levels at a government level. So effectively, governments took payments and asset transfers and transferred it to business and gave checks in the mail to consumers to get them through these difficult times. So consumers really locked in their houses, not being able to travel, not being able to go out, did what we normally do, which is buy stuff. And consumers went on this massive buying spree and effectively ramped up their purchases to the extent that there was not enough a supply of many of these products to be able to meet the levels of demand. And I'm sure you guys, in some form or other, have experienced this lack of supply, whether it's waiting for a new Hilux Bakkie with the new 2.8 diesel engine, whether it's waiting for some part for your wash machine. I waited 5 months for a belt for my wash machine because of the supply chain problems. So the support that governments injected into markets really resulted in consumers and this big kick in demand, and that has fed through into companies' earnings. So companies really have been generating super profits because of this very powerful recovery, and you've seen the earnings growth exceed expectations in terms of what the companies have delivered. and also to the extent that people have engaged the online retail channel a lot more than perhaps what they did historically. So I think these changes in behaviors are probably going to become more entrenched, but the long and short of it is that companies have really done well and benefited from this massive injection of money into the system, and when consumers have then, chased buying products, buying goods and services to the extent that they couldn't travel or do all sorts of other activities. So that's been a very powerful underpin in terms of the economy, but it has resulted in certain supply chain constraints. And at the moment, what we're seeing is that the global supply chain is not really built to deal with this huge level of injection of demand that we're seeing from consumers. So let me give you an example. Many of you who run your own businesses or are part of businesses would know that businesses today have been run on a just-in-time basis. In other words, when you have a client who needs that product, you order the stock and you get the stock on time, and you can then conclude that sale. What's happened is there's not enough stock, and the warehouses are not in a position where they've got stock, so the whole supply chains have exploded to the extent that you cannot and businesses cannot meet this excess demand. And this is injecting huge pricing power and inflation into the system. And interesting, I've waited almost a year to buy a car, and I was waiting and I wanted a Prado, and a used Prado was trading at a 20% premium to what a new Prado could trade at if you could get it. That just shows you the demand. And I think the point here is that this inflation working through the system is starting to push up inflation expectations. So generally, economies are in a good place. From a developed world point of view, unemployment is low, wage rates are growing, people are getting wage increases way in excess of inflation, and there are lots of jobs that can't be filled. So this is quite a positive, buoyant environment, but at a time when there's limited supply of product and goods because of a whole host of these supply chain reasons. So with that backdrop, I wanted to share with you some of the opportunities or the areas where we think there are places to be focusing on earning those excess returns, and perhaps more importantly, some of the areas where we think you should be avoiding some mispriced assets. So the first opportunity I wanted to say is I hear at sort of the bras and many of the dinners that I go to, everyone talking about cryptos, and I know there's probably going to be a discussion a bit later, but we would say this is an area where you really need to be careful. This is evidence of bubble-like mentality. There's lots of leverage in the system. When interest rates go to zero and stay low for long periods of time, leverage builds up and people take risks that they shouldn't be taking. And we think that we're getting to a point as inflation's pushing through the system that we're likely to see rates and interest rates rise. Perhaps not to historically high levels, but certainly move up from the low levels. And we think the likes of the cryptos is probably the canary or one of the most or the better indicators of the excesses that you are seeing in markets. So that's the first thing I'd say to you as an opportunity. If you've got cryptos, sell them, because we think that this is a bubble, and as interest rates normalize, you're going to see many of those come back down to earth. The next opportunity is also about avoiding something, and it's avoiding expensively priced growth assets, particularly long duration risk assets. So if it's a long duration bond overseas, we think the probability of losing money over the long term is almost guaranteed. If you are buying into many of these long duration equities, in other words, lots of these very highly priced tech shares, Tesla would be an example of one of them, where there is so much good news that is priced into lots of these businesses, we think the likelihood of actually earning a reasonable return over the long term is very low. And the probability of impairing or losing capital is high if you get interest rates which just rise back to pre-COVID levels. So we're not suggesting there's hyperinflation or interest rates are going to rocket up to 5%. We think it's just going to normalize. And we think one of the areas to preserve capital, and that's what we do on your behalf as a fundamental manager, is to make sure that we avoid putting money into assets where we can permanently lose capital. That's an important part of generating the real returns that you guys need to meet your liabilities. So avoid the expensive growth and long duration assets. At the same time, there are pockets of value around the world. And certainly if we look in some of the emerging markets, some of the markets in Asia that have been smashed, and in Europe in particular, there are definitely pockets of value where there are decent companies trading on dividend yields anywhere between 4 to 7% in the case of some of the oil and financial companies where they are growing their earnings. And importantly, you are not paying an expensive price to access these investments. So in an environment which we think we're moving into, where inflation is starting to push higher and where the likelihood of interest rates pivoting and slowly moving up, that is going to be a headwind for growth shares and long duration assets, but in fact a tailwind for some of these high yielding value type shares. And that's where we are seeing some value. And in fact, South Africa falls into this category. So South African assets, unlike many of the other assets around the world, actually looks pretty compelling and cheap versus historic comparisons. And we all live here and we know the story. We have load shedding all the time. Sometimes we don't have access to water. But the reality is, if I tell you the economic performance of our companies listed on the JSE has actually been quite resilient and good, and you are able to buy into these businesses today, some of them are great businesses, at a fraction of what you would have paid for them 10 years ago. And that's where we're seeing some opportunities right back home, where the rest of the world has almost given up on us, but yet we've still got some world-class businesses which maybe they're not benefiting from an SA economy growing at 5%, but are still growing and taking market share from weaker businesses. So that's where we're really seeing opportunity, and certainly there's lots of that. So to give you just a flavor of where we're seeing value, certainly in the telco sector, we're seeing it in the likes of some of the SA industrial companies, Remgro trading at a massive discount to its NAV, business like Astral, which produces chickens. Effectively, you can buy that business on a forward multiple of below 7 times and a dividend yield of around about 7%. And with a business that has no debt on the balance sheet and generates very, very high returns. So we think within this SA opportunity set, there are definitely some very good businesses that one can still buy, where the prospect of earning double-digit returns is still quite high, and yet you don't have the risk of those expensively priced global assets that I spoke about that have had the benefit of interest rates falling for such a long period of time. So I think when we sort of think about South Africa, that's the equity side of it, but we've also got the fixed income side. And some of our bonds offering you real returns of close to 5% are very compelling in the space of a global investment universe where there's very little yield on offer. In fact, offshore, pretty much when you buy a bond, you are certain of losing purchasing power parity of your money because those bonds earn you negative real returns. Whereas in South Africa, we are still able to earn a positive real return, and if you're happy to go out sort of 10 years on our bond curve, you can buy instruments which are giving you close to 10%. So we're not rampantly bullish on South Africa turning around. The speed of transformation in our economy in terms of economic transformation and restructuring has been painfully slow, but there are signs of positive movement. And certainly the global resource cycle and the recovery of the global economy has helped South Africa to the extent that the tax receipts are going to be significantly better than what was anticipated 18 months ago. So our debt levels will come down, and there's enough money if we can just get the administrative skills back in government and municipalities to start repairing roads, repairing waterworks, and then of course focusing on the power. So we think there's lots of opportunities. We think that the outcome of the local elections is positive to the extent that you've got coalitions and you're hopefully going to hold some of these guys to higher account, and really to say that there's lots of opportunities right back home. And in a world where global assets are very expensive, we're finding lots of comfort in attractively priced local assets, but focusing on those better businesses. And hence we think by doing that from a sensible point of view, taking the risks we feel are prudent, we can still generate decent returns, real returns for you and your clients, but at the same time managing that risk and managing the risk of permanently losing capital. So hopefully that gives you some sense of how we're thinking, and thank you once again to Johan and Henry for inviting us to speak at your conference.
Happy that you guys could take the time out to come and talk to us and to our clients. I think we always try to follow a process whereby we give a reason to our clients as to why we suggest certain allocations in their portfolios. And it's a difficult thing to explain in a couple of minutes to people. We usually see that it takes us about 2 years in constant feedbacks on a 6-monthly basis to our clients to make them understand the investment process a bit better. We always bring the economy into play, Kevin, just to put a backdrop to clients and to explain to them in what context we make use of you guys on the allocation side. Then we drill down into the portfolio managers themselves. And Ian, always great to talk to you as well, and wonderful to hear your philosophy and process that you follow. And we also see that in the outcomes of the returns. And as you've explained as well, is that we've had a hectic 19 months that is past. I think all of us are quite tired. Those of us who were privileged enough to go down to the beaches last year were horrifically stopped in our tracks, and you're not allowed on the beaches, so you could look at it, but you can't go there. And that was not a nice experience to all of us. But we're grateful for all the work and effort that you guys are putting in. It's critical for myself and Henry to make use of all the information that you provide to us. And we try to collate that information as best as possible and transferring it onto the clients and do the allocations as best we possibly can. So in that, let's move on to the panel discussion. And Henry and I are just going to put a couple of questions to you guys. Trying to put the clients in a perspective as to how we approach certain allocations. So I think, Kevin, it would be prudent just for me to ask you on the purchase price parity index and the rand against the other currencies. How would you see the value of that to be in the current economic environment?
So from our perspective, the rand is technically undervalued. You would argue right now that probably the fair value for the rand is in the order of 14 Rand 50 to the dollar. But we have to be clear that it's very seldom that the rand is actually at fair value. If we look a little while ago, the rand I thought was exceptionally strong, and a lot of that had to do with these wonderful export revenues that we've been able to attract over the last 2 years. But it is the exception that we find the rand at fair value. So I'm not overly concerned about where the currency is at the moment. I think that it's not likely to feed into significant more inflation on its own. What we would be more worried about is as countries around us start to put up interest rates, particularly other emerging markets, it tends to put other countries who are not yet putting up interest rates under pressure. And we can see that in South Africa, and I think our Reserve Bank will respond with interest rate hikes on their own. And that's difficult for clients to understand, because when you look around in the economy, you say, gee, this economy is dead. There's nothing happening. The consumer's under pressure. Why the hell are you putting up interest rates? And part of the reason the Reserve Bank puts up interest rates under current conditions is because the rest of the world is moving in that direction, and it kind of forces us, unfortunately, to also hike rates. Otherwise, we struggle to attract foreign investment, and then the rand comes under pressure. So I think the rand's actually behaved reasonably well. It remains vulnerable. We're a small open economy. We would still be having a significant exposure offshore because of that, partly because of that risk that the rand comes under pressure. But when I look back at the COVID era, I think the rand, it's been a bit volatile, but I think it's actually done reasonably okay.
In talking to the strength of the rand, Johan, or the performance of the rand, maybe a question that we get quite a bit from investors, and also if you read in the media over the weekends, you know, there's quite two camps when it comes to how much do we need to have offshore as investors. My question maybe to Ian on the Truffle Flexible side, and if you want to come in, please do, Kevin, is in a Reg 28, local multi-asset class fund, do you think investors already have enough diversification across asset classes, but also have enough offshore exposure if they specifically reside and spend in South Africa, experiencing inflation in South Africa? Or do you think we actually need to have, as investors, more offshore exposure on top of that? Ian?
No, thanks, Henry. I think that's a good question. I guess, the first statement would be is that we have foreign exchange restrictions, so that's a fact. I think if you look at other geographies around the world, for example, if you talk to someone who lives in Australia and say how much of your assets do you have invested in Australia, I mean, they'll invest in global equities. So I think South Africa finds itself in a position where, because of our history, we do have foreign exchange controls. So, I mean, our view is that we would have the max, first of all, and that, from a global perspective, I would think that as foreign exchange controls are relaxed in countries like we see around the world, you would probably shift some more of your assets offshore. But now, having said that, if you look at the makeup of the JSE, there's a big chunk of our market which already earns its income outside of South Africa or sells commodities to global customers and clients and then gets paid in dollars. So, and I mean, that's closer around about 70% of the market. So, I mean, if you think about that portion of your equity, the amount of sort of equities that are focused domestically is much, much smaller. So I think, inevitably companies in SA have also tried to diversify, given that growth in SA has been stagnating since the Zuma era, where we almost dislocated from the median global country because of what happened. But I mean, the reality is I think our clients already have a lot more than the regulatory maximum because of the makeup of the market. But I think it is sensible to have more of your exposure offshore to industries and sectors which we don't have in South Africa. So, our market is becoming more concentrated, and I think some of the value which is apparent in our market is resulting in some takeouts of many of the small and mid-cap businesses, and you're seeing actually the universe shrink even more. So, we would say you can't get exposure to a diversified a tech environment in South Africa. We have one opportunity, so we can't invest in biotech in South Africa. Many of these industries which are emerging, where there's been dislocation, and they are the beneficiaries of technology and change, we don't get to invest in those in South Africa. So I would say from a client point of view, you want to have those levers to pull and to have that benefit. So I mean, like our number is probably closer to 65% of your assets should be offshore.
Great stuff. I'm going to extend the question that Henry posed to you, Ian, and then I want to bring you in, Kevin, on that as well, from an inflationary perspective. But on an asset allocation view, there's always this debate on what is actual asset classes. And a lot of the debate has been about the cryptocurrency recently. To me, in my archaic mind, most probably, I still see 4 asset classes only in equity, cash, bonds, and property. Every now and then, every couple of years, there's some kind of a new investment trend that develops, and people want to typify that as another asset class, or define it as another asset class, which I don't believe it is. But just putting the clients in perspective, you have to also act according to your mandate, and according to that you have to make your asset allocation. And therefore, what's your view on the different asset classes? Do you really think there's other asset classes that are applicable? Or do you maybe also follow the view that there's only the old traditional 4 asset classes that still prevails? So following on that, on inflation side, it's quite important to invest in the correct asset classes. And you sent out a nice summary of inflation for different income bands a couple of years ago to us. And I quite enjoy that, because I saw in that the inflation on the CPI side is not actually the real inflation that a lot of people live with. There's the petrol prices, maybe a more prevalent factor, medical aid contributions a more prevalent factor to the high net worth level maybe, and that makes that inflation different to other levels, and therefore your returns often needs to be different, because often those people in a different income category needs to generate more income. So it's a loaded question here to both of you guys, but if we can start with you, Ian, and then move on to Kevin.
So from an asset class point of view, is that, and I suppose, talking to cryptos specifically, we think it's a function of very, very low interest rates for a long period of time. And I mean, I'm not talking about blockchain technology, because we think that's very relevant, but certainly cryptos in terms of an asset class as being a real asset, I would question that. And I would say that the price performance of those cryptos very much linked to liquidity in markets, the ability to leverage, fund these positions. And I always think about something that I read from George Soros, where he said, when you have periods where interest rates are very, very low for long periods of time, you get leverage and excesses building up everywhere, and in places that you wouldn't really think. So from our perspective, that's just another manifestation or result of people being able to access credit or capital at very low cost and take big bets. And I think that's going to wash out of the system. So I mean, as I said earlier in my talk, I think it's an area that we would advise clients to avoid, because I think the risk of permanent capital loss is high. I think the traditional asset classes, real assets, whether it be property or listed property or art or, vehicles, whatever it is, as long as a real asset, if we're moving into an inflationary type environment, typically you want real assets. Bonds, I think, as I said, I think are expensive from a global point of view. I think our local bonds are actually quite cheap. They're actually quite reasonable. You get good real returns. And I think it's those real assets in the long run, if we are moving into a period of sustained higher inflation, those are the assets which will protect you in the long run.
So in terms of inflation, it's obviously critical from an investment point of view, because obviously that's the first gauge that fund managers are using. Can I give my client a return that at least beats inflation on a consistent basis? And if you're not doing that, your client's going to be unhappy fairly quickly. So when we measure that inflation, what we tend to then do is just feed off what the overall inflation rate is that the government produces, that Stats SA produce. And in South Africa, that in the last while has been 4.5% to 5%. And so that's kind of used as the yardstick. But Johan, what you say is absolutely true, that there's a difference between what I call experienced inflation and measured inflation. Measured inflation is what you see as the number in the newspaper, the headline inflation rate could be 4.5%, 5%. That's measured, that's technically correct. It's measured on an international basis, the same way in South Africa as it's done elsewhere. There's nothing wrong with that. But it's not what people experience. And let me explain right now why it's a particular issue right now. So if you think about the items that you encounter every day, there are two items that stand out. Fuel or transport, the cost of transport. You experience that every day, and cost of food. Now, food inflation in South Africa at the moment is 7%, so significantly above the inflation target. And if you look at petrol inflation, it's currently 34%. So already, just on those two items, your average inflation rate is well above the measured inflation rate. So what brings measured inflation rate down? It's items like, let's say you buy a fridge. So if you look at the inflation rate for appliances, fridges and freezers and washing machines, that inflation rate is about 1% at the moment, right? The problem is you don't buy a fridge every single day, at least I hope you don't, right? So you don't experience that very low inflation rate. In fact, you may buy a fridge only in 5 years' time, and then you wouldn't have really known what the inflation rate is about, yet that is included in the calculation and it brings the average down. So right now, people are experiencing much higher inflation. Take electricity. Electricity inflation at the moment is 14%. So let's add that up. You've got food at 7%, you've got petrol at 34%, you've got electricity at 14%. Then you've got education inflation, which is going to be higher. You've got some medical costs, which are going to be higher. That takes up a lot of the money that you're actually spending, which means in truth, the fund manager actually has to work quite a lot harder than simply beating the 4.5% or 5%. And clearly that creates a lot of pressure. And how do you go about trying to do that? Now, one of the things that stands out for me is that typically in South Africa, unfortunately, the rand has a tendency to weaken by more than the inflation rate, right? Over time, that's essentially what's happened. And so if you are keeping all of your money in South Africa, then not only are you struggling to meet the local inflation rate, but on an international basis, you're becoming poorer. And for that reason alone, you have to have a significant amount of your exposure internationally. And clearly that would have helped you, right? If you'd had over the last, let's take this year so far, the US stock market is up, I think it's 26% in dollars, 26% in dollars. That would handsomely have beaten your local inflation rate. Now, it doesn't mean you're going to get 26% every year, obviously, but over time, the US and global markets have done reasonably well. And that's what Ian would be skilled at, is diversifying into those regions and looking for where that opportunity is so that the combined portfolio exceeds the local inflation. You're obviously going to have some money in cash. And part of that is either just to be cautious, or part of that is just to have some available funds. But you've got to recognize that that cash investment, gee, it's going to struggle to beat inflation. So the last thing you want to do in South Africa is sit with your money in the bank. That's really going to hurt you over a period of time, both domestically and when you go internationally. So inflation is critical, and understanding what your real inflation rate is also quite important.
Kevin, thank you very much. I want to come in on that last point, and it's a question for you, and also then bringing it back to Ian on the fund management side as well. Where do you potentially see some of the biggest mistakes in the current environment being made by South African investors? People that's going into retirement. We've gone through a period of volatility last year. The market went down 30, up 32 in 2 months. Nothing one could do about it. From our point of view as advisors, individuals are scared of volatility. They're missing the ball, or not keeping their eye on inflation over the longer term. And also, if you bring it back to what happened, I mean, we all understand that markets move in cycles, but we've gone through a period now, specifically in the Regulation 28 local balanced funds, local medium and lower equity funds, from the period of May 2014 all the way up to end of 2018, we've seen some of the lowest returns, and some of these funds not beating inflation over a 5-year period. In the same breath, we've seen income funds and money market doing better. And we are concerned that investors are sticking to that game plan and not adjusting. And what we've seen is we think the winds of change have already started to happen, and that the market or the investors will miss out on quite a bit of return if they wait for this conviction to be built up to see when am I going back into to the market. If you guys can just maybe expand on that.
So I'll touch on 3 things quickly that I think local guys are maybe not that mindful of. I don't want to say it's a mistake, but I'm saying they could be more cognizant of. The first is being way too conservative. When we look at the data, too many people are sitting with money literally in a bank account or in a kind of 32-day notice account, And some of it may be just a lack of knowledge to go into other assets. Where do they go? Who do they speak to? Some of it's just outright conservatism. Some of it is just fear of what market volatility can do. So I think people are way too conservative. The second thing is that there's a tendency, having invested and having been explained to individuals that this is a long-term investment, at the first sign of trouble, people panic. It's the worst thing you can do. And I can understand that panic, because now your investment, your retirement money seems to be going backwards. And at that point, you're now scrambling, you're shouting at your advisor, you want your money back, but you're pretty much probably going to be selling out at the bottom of the market. And I think that's a mistake that a lot of people make. The third mistake is they chase the fad. In other words, whatever is doing well today, they think will keep doing well next year. So they look and say, oh, this did very well, so I'm going to invest in that. And it may be gold, it may be some cryptocurrency, it may be a particular share. And they pile into whatever is doing well, only to find out that it's just a fad and that it fades. Instead, if you look at the data, what really works for you is coming up with an overall strategy in terms of a balanced portfolio, giving it to an expert like Ian and saying, invest for the long term, a genuine long term, 5 years, 10 years, 15 years, and then stick with it, leave it alone. You know, guys like Ian are experts at this. They invest, this is what they do all day long. This is their livelihood. Leave it to the expert, and over time you'll be amazed at how this performs. And I think that we're just not brave enough in South Africa to put our money to work and see what it can do over a period of time.
Okay, so just maybe echoing to Henry's question there, and I think Kevin's touched on a few things, and I mean, maybe what I would say is that given also the opportunity or some of the valuations of the SA assets at the moment, given everything that sort of happened, there's really opportunities to earn still decent returns from many of these assets, and we do see it. We see people have that fear, in terms of losing principal. And I mean, we know people are a lot more afraid of losing money than they are happy when they make money. So, and I mean, that's just a fact. So, the reality is people do need to take that risk, because you only earn the real returns that Henry spoke about by taking that risk. And unfortunately, the reality with some of these risk assets, particularly the equities, is the returns are not predictable. So in other words, we can buy a portfolio of cheap assets where, the business, Astral, we think is worth 250 Rand, and we can buy it 180, and we know we'll hold this thing, we need a dividend yield of 7, and our pull to par, there's a 20% return coming here, but we just don't know when. Okay, so the problem is you can wake up tomorrow and that return just comes. And I think it's like you said, markets can go down, but they can recover very quickly. And I think that's something that investors need to just be comfortable with, that, asset prices can vary around an intrinsic value of the business. The value of the business hasn't changed. The market's just pricing it differently. And that's the way we sort of look at that value over time, and then take advantage of the difference between price and value. And that's when we can add those returns to clients. But the harsh reality is, even the experts, no one can time that. There's no one who can time that. So you need to have the risk asset exposure when you get those explosive returns. And I think you guys have shown before on some of your slides, if you've missed sort of the top 10 weeks or days of the market, if you weren't in it, what your return looks like after that, and it's chalk and cheese. So the reality is, you've got to stick to your plan. Don't sit on cash, as Kevin said, especially now when the yield curve is so steep and you're getting nothing on the short end, and most of the value that you're going to get is going to be a little bit further out. You're going to have to take a little bit of duration, but the returns are decent, and I think you got to stick to your process. And when you are feeling sick in your stomach, that's when you should actually put more in. When you are cracking the champagne cork, you should be thinking a little bit carefully about the money that you've just made, and maybe it won't be sustained at that rate. And that's typically how it goes.
Absolutely, I fully agree. In talking about process, and linking up to your fads, I think one of the discussion points at Braai's, especially after the third beer, should be not to speak about investments, because everybody becomes fundies at that stage. Reality kicks in when you actually are at the advisor's office the next day, and you need to actually decide on investment placements itself. So on that point we need to remain as objective as we possibly can. And in applying that objectivity, we do our regular due diligences. We've been obviously to both of your offices in the past, and I've experienced and have been exposed to your environments. So in giving a client a glimpse on the environment, I wish we could take all of them along to some of the due diligences and the visitations to see how the setup actually looks. I sometimes think it's unfair where the likes of 91 and Allan Gray are situated down in Cape Town, having a lovely view over the sea. But we're closer to the actual action here in Gauteng. But in doing that, we also do an offshore due diligence annually. And I was once one of these times we visited 91 in London, and we were taken down to the trading area downstairs, and where all the fund managers are actually sitting. And we saw this one guy with 6 computer screens in front of him, and I had to take a photo of that. That was something out of this world. But yeah, just on all of those points, I wish we could take all the clients. We unfortunately cannot do that, but we do that on their behalf. So getting to the point, and maybe on a bit more of a lighter note, how does each of your guys' day look? What do you do when you arrive at office, or prior to arriving at office? We've come to understand that some guys put on the television before they say hi to their wives or husbands. And just in general, how does your day look? What do you look at when you wake up? Do you look at China first? And do you look at the rand dollar prices or the euro prices? Ian, do you look what's happened to Richmond or to whomever out there, or British American Tobacco? What do you think about? What makes you tick on a day-to-day basis? For us, it's critically important because we like strength of conviction. When we do our qualitative analysis on the fund managers, we try and understand that you really like investment. Otherwise, it may become just a job, and we're quite cognizant of the fact that we want to see your full heart in it. So yeah, thanks to both of you.
So my day is really news. It's all about news. What I'm trying to work out is what are the news developments in the key regions around the world. I can't look at everything, there's too much going on. So we tend to focus on the United States, the biggest economy in the world. We focus on China, the second biggest economy. And then we'll focus on the Euro area as a collective. So I wouldn't spend a whole lot of time looking at Spain or Italy or Portugal. It's too specific, but for the Euro as a region. So my initial thought is, what are the news items coming out of those parts of the world? And has anything changed that I need to be aware of, that I need to perhaps investigate a little bit more? So take when Evergrande was in the press a lot, the property developer. There would be a lot of things developing on Evergrande that you want to check up, because it's a critical stage for that property developer, and you want to know if something radical has happened. So there'll be a couple of stories in your mind, a couple of themes that you want to check up on. The next thing you're going to be doing is having a look at what are the key events that you've got to be aware of today. What data is coming out, what press conferences are happening, what news is likely to transpire, and what do you need to interpret about that? Have you got the data? Where do you get the reports from? What are you going to be trying to get out of that? And so for me, it's a lot of reading, a lot of data manipulation, a lot of writing of stuff, and then it's just repeat, right? Every single day it's repeat. And there's a tediousness to it. So you don't want to glamorize this, right? This can get very tedious because it's perpetual. And what you find, bizarrely, this is bizarre, if you go on leave for 2 weeks and you come back, your feeling can be, I don't know what's going on. You start to panic. I'm out of touch. And so you have to catch up with that. So there's a lot of that perpetual assessment of numbers, of data, of reports, just so that you are aware. And that then can put you in a position to do specific research projects. And those research projects may be something that your fund managers are looking at. It might be something to do with inflation. Your fund managers want to know, so how bad is inflation going to get? Let's look at that specifically. But you need all of that background information. Once you've got that, you're in a better position to answer that question. So you're trying to use this information to then get to some sort of investment outcome.
Okay, thanks, Johan. So I mean, my day would start pretty early in the morning. I let the dog out first, but no, seriously. So we are focused on things which affect value, the value of the assets. So that can be the discount rate, could be inflation, could be interest rates. It could be the company-specific factors, anything company-specific. So, has something happened to that company in terms of maybe its business, the business model, has something changed which would affect the value? Because what we try and do every day is to do as much research as possible to understand what the value of all these assets are. We then compare price to that value. So value is quite a stable concept, and the value of a business grows slowly over time based on its internal return metrics. But we know price cycles around that, depending on investors' optimism or pessimism if something has happened. So I suppose my day and our day is about looking for any factor that affects the value of that business. First of all, if something comes out, Tiger Brands, listeriosis, I mean, does this permanently impair value in the business? Nigeria, for MTN getting a massive $5 billion fine. I mean, what does that mean? What does it mean for the value? Okay, so it's spending a lot of time understanding what the assets are worth, because that gives us a sense of what we're prepared to pay for the asset to make the return that our clients need to meet their liabilities. So I think that's the one side of it, and that list is long because it can be macro, as Kevin has spoken to. It can be company specific, or it could be industry specific. For example, Chile, Peru are talking about extra royalties on copper mining in those countries, because there are new governments which have been elected and they're moving more towards populist policies. So now if suddenly those companies, whoever mines there, has to pay a bigger royalty to the government, what that does is it lifts the cost of production. And those are big copper producing countries around the world. So just something like that would be relevant to when we're holding a Glencore in the portfolios. And what does that do for the cost curve of the copper producers, and where would the 90th percentile producer sit on the curve? And it would give us a sense about what prices we use to input into the models when we valuing a business like a Glencore or a Freeport McMoran, etc. So I think that's the company specific piece. The other piece is looking at the volatility in markets and what prices are doing. So understanding the value is the first important part. The second piece is, if for whatever reason during COVID, Capitec share price, give you an example, fell 70% over 2 weeks, and on the one day tanked another 30% because there was forced selling by banks who had given loans to certain directors, and they had to sell those shares. So if we know Capitec is worth 1,600 Rand and suddenly the share price is down at 700, 650, that's important, because that's an opportunity, because volatility for us is an opportunity. For a Capitec holder into that is pain, that is you feeling sick. But for us, we are rejoicing, because we're saying, here's a business, it's a good business, it's worth 1,650 Rand, I can buy this thing at a fraction of the price today. And then we move in and we start taking advantage of that volatility. But the only way you can do it is knowing what they're worth. So most of the time is spent understanding what they're worth and then comparing the volatility and what the prices are doing versus those values to see where the best return opportunities are for our clients when that mean reversion process slowly unfolds over time.
Being cognizant of the time that we've got still with you, I've got two names, and I want to throw one at you, Kevin, and I just want you to run for a minute with that, and then Ian, yourself as well. Totally non-correlated. Kevin, Eskom, it's in the news. Where are we with that? Ian, Tesla. I mean, it's a cult following. It seems like the world's pricing in that we're all going to drive Tesla. We had a discussion off camera, and both Ian and myself are still, passionate about Africa. So we still like our V8 engines and being in the bush. So if you guys can just maybe talk to that. Thank you.
So Eskom, I think it's under better management now. I think they are trying to effectively turn it around, and I would have more conviction that the management is doing a better job and is on the road to turning around Eskom. The difficulty, I think, is that senior management within Eskom themselves have miscalculated the extent of the decay that took place in Eskom, both in terms of a lack of maintenance, a lack of staff morale, a lack of skills within the business. And I think clearly it's going to take a lot more time to get it into the shape that it needs to be for South Africa to be economically more successful. So I think we are in this phase now of renewed load shedding for an extended period of time. I am optimistic that we're going to see more private sector investment in the energy field during the course of next year. So I do think that over a period of a year or two, the pressure will ease and then systematically continue to ease. But it's going to be some time before we feel in this country that we are past the electricity crisis. And one of the things that struck me about Eskom, I listened to a press conference last week or the week before from Jan, who's their chief operations guy. And he was trying to explain where this additional load shedding has come from, and obviously a difficult job to explain that. But one of the things he said which shocked me was that they are aware of their own staff being negligent. He used the word negligent. And the example he gave was that at a power station, you would have an alarm going off. The staff need to do something in response to that alarm, and they simply choose to do nothing. That's negligence. And because they've done nothing, you get a further breakdown in your electricity output. So if you're trying to run a business like Eskom, which is all over the country, it's got lots of staff, and your own staff is being unhelpful to that process, it's a difficult thing to turn around, if impossible to turn around. So I think we haven't fully understood the extent of the damage at Eskom, and I think unfortunately it means that we're going to live with power as a problem for some time to come.
Okay, so on Tesla, I mean that's a good one. I think it's a good question, because I think Tesla is one of those shares which I spoke about earlier that is benefiting from very low interest rates, lots of excess liquidity and high risk taking. And I put it in the hopes and dreams sort of category. Not saying that Tesla's not going to be successful. So we think Tesla's going to be successful. We just don't think that the market cap of Tesla is worth all the other vehicle manufacturers in the world. So I mean that's literally what it is. And the reality is that they are profitable, but it is not worth $1.2 trillion in terms of its market cap. So if you had to put it on a traditional sort of valuation multiple, to justify the high multiple, they would have to be growing at a much higher rate, which is just not possible, given that you need factories, you need batteries, you need robots to put these things together. And it's a sign of excessive optimism in the market, and would not be a place where we would say you're going to make decent returns. The place where you're going to make decent returns is probably in some of the oil companies, which have been ignored, and there's ESG concerns, and people are just not drilling for new oil supplies. So that looks a lot more promising, rather than for example a Tesla.
Awesome, thank you so much. I see the timekeepers have called on us to stop our conversation. In our normal due diligences, it usually takes us an easy part of 2 hours just to understand some of the information that we can access from you. But I again want to emphasize the fact that we appreciate it a lot, being here and allowing us to dip into that pot of honey knowledge that each of you guys have. We also want to make use of the opportunity to thank you for what you're putting into the industry. I spoke this morning to a friend of mine in saying that if we have to realize that we are in the service industry, financial services, and not in the financial money-making industry. So we are at service to clients, and we see that as our calling. We need to emphasize that on a day-to-day basis to our clients. So we rely heavily on you guys to give us the economic backdrop and also the fund management backdrop to be able to put us in a position to advise well to our clients. So thank you so much. Good luck for the rest of the year. We hope that it's a quiet one moving into Christmas time. And Merry Christmas to all of you guys, and enjoy the rest. And therefore we sign off. Thank you so much.
Thanks, Johan.
Thanks,
Henry.
Johan. Thanks, Henry. Thank you.
Ladies and gentlemen, that brings us to the end of the 10th Annual Investment Forum for Latitude Wealth. Johan, I mean, what a year it's been. I don't know if there's any highlights that you want to maybe just revisit in conclusion, and then we'll take it over to the thanks.
Thank you to you for a wonderful year. We had an amazing year. It was very eventful as well. Much less than we anticipated. We thought to be seeing a lot more volatility, but the markets were good to us. I think our investment process worked exceptionally well. Such a process can only be tested in bad times, essentially, because in good times, everybody can do well in any investment. But from my side, I just want to thank you, and then the ladies obviously as well. Without them, it's not possible. Sometimes Henry and I feel we're running in a direction, and we're leaving a wake of work behind us. And they pick it up, they clean it up, and they formulate it, package it, and make the experience to you as the client and to us as seamless as possible. And that's critical in our business, to have a seamless environment. And it must be a nice journey for you. Sometimes there are hiccups, and we have to correct those hiccups, but we're not scared to do that. It's sometimes frustrating as well, but I think a low light for me, just to not focus on the highlights only, is the fact that we couldn't do as much due diligence as what we usually do directly with the fund managers, as we experienced with Ian and Kevin. It's important for us to look the guys in the eye and to ask them the questions we want to. We often refer to the fact that when we sit in a boardroom situation, when we do a due diligence, the guys usually prepare some kind of a presentation. And then Henry and I ask way off questions sometimes left field. But it's important so that we can test the ability of the fund managers and to see whether they are doing the things we expect from them. And in doing that, it's sometimes difficult to ask a question to a screen. And the webinars is great, and the interactive sessions via Zoom and MS Teams is great, but it's not the same. So hopefully with the vaccinations kicking up as it is, and the virus infections going down as it is, we'll be able not to only visit the fund managers more regularly again with our due diligences, but also you as the clients, to come down to the rural areas and to the coastal areas, which we have always done. We miss that. It's always a good experience to go and give feedbacks up there or down in Mossel Bay, up to Jeffreys Bay, and give the feedback to the client over a week period. But all over, I just am very grateful and thankful. I think it was both a hard year, but also a very, very good year for our business as well. Latitude Wealth has settled down as a name very well, although US clients have been with us for many years. We appreciate you as clients the most, and we love interacting with you. Sometimes it's a bit daunting, especially if the markets are down, but in most it's great to always have the ups and down discussions with you and to keep you informed as best we possibly can. So yeah, thank you basically to the whole team from my side. Yeah.
Guys, from Johan and myself, thank you, Johan. Just a big thank you to yourself as well. I think it's so critical to be part of a team in this environment. In South Africa, we live in fast-changing times and challenging conditions, and we want to encourage you as our clients to remain positive, to be aware of the risks out there, but keep being positive. It's just good for us all. We are all pulling in the right direction, I believe, in South Africa. From Johan and myself side, to you as our clients, just a really big thank you for the trust that you do place in Latitude Wealth. You have our full commitment that we will remain committed, independent and objective in our advice to you. So a big thank you to the clients. And then just Johan, a big thanks to Kevin and Ian from Truffle and Stanlip for being our guest speakers. I think they were phenomenal. I think we would all agree. And then again, just as well to Salman and Monica from Vlakvak Productions, a big thank you for the recordings and just in making it such a professional setup for us. Thank you. All the best. Have a wonderful Christmas. If you travel safe, and we'll see each other in the year 2022. Cheers.
Merry Christmas.